What's going on, everybody? It's Brian Trippe. Welcome back to another episode of the REI Live podcast. We are real estate investing live, and we interview the very best real estate investors, entrepreneurs, and business leaders all throughout the country. And today, I've got Chris Miles on the show. And Chris, I don't know a lot about you, but I've heard of your podcast. I've heard a little bit about you. I want to get to know you on the show as our audience does. So how's everything going today?
Yeah, fantastic, man. Doing great.
You said something a second ago, right as we're trying to get to know each other a little bit, that really caught my ear, and I want you to really dig deep on. And I hope maybe we're going to spend a lot of the show talking about this. Passive income is obviously a big key to real estate investing. Everybody wants that. But you said something a second ago that, and I've seen it on your Facebook page before. You said you're the anti-financial advisor.
Mm-hmm.
What does that mean?
Yeah. Well, like you've met with the traditional crappy financial advisors, right? I mean, good-hearted people, but they definitely are not the people you go to if you want to become financially free, right? Because they tell you to save everything, spend nothing, save it forever, save it in dumb mutual funds. So hopefully someday you might have something, right? That's a pretty much basic message, and they're like Mexican food of financial advice, aren't they? I mean, you think about Mexican food, it has the same ingredients no matter what it's called. It doesn't matter if it's a taco, burrito, tostada. I mean, they all have the same basic ingredients, right? But you just put a different name to it. And that's all financial advising is, hey, let me sell you either mutual funds or insurances, right? And that's it, and then that's somehow supposed to make you financially free. Yet no one has been able to become financially free yet. And I know that because I used to be a financial advisor 20 years ago.
Okay.
I started out down that path. Did that for 4 years. And then it wasn't until about the end of 2005 that one of my friends who left to do real estate investing, told me, he's like, Chris, my dad and I have partnered on some deals, and it's crazy. Like, we've doubled his income as a professor at the local university. I was like, you just started this 4 months ago. Like, come on, that's too good to be true, right? That's the kind of thing that from a financial advisor's point of view would be like, no, come on, because it takes high risk to create high returns, right? He's like, no, man, that's not it at all. And we started getting this debate about what's better, stocks or real estate. And he stopped me. He said, Chris, how many of your clients are actually financially free where they don't worry about money? Not just retired, but they're not worried about money. I said, well, none of them, because the ones that are retired watch CNN all day, and that never makes anybody happy. So you can't do that. So he's like, okay, well, good job, Chris. Way to help nobody. How about this? How many of you guys as financial advisors are financially free, not off the commissions you've been earning, but actually doing these investments? Like, you could retire off the investments alone. And I thought about it. I was like, well, none. Maybe this one guy would. But I mean, there was guys that had been in that office since the late 70s and still were not able to retire. He said, there's your problem, Chris. I'm like, all right, well, give me the answer. He's like, I won't give you the answer because you just got done telling me the stock market was better. I'm like, no, come on. Like, I'm open now. Give me something. He said, Chris, if you're serious, go get this book by Robert Kiyosaki called Who Took My Money? It's a lesser known Rich Dad, Poor Dad book, right? And then go listen to this AM talk radio show locally here in Utah that has these two real estate investors talking about the things they're doing. And so I did. And a few months later, March of 2006, I said, I can't teach this crap anymore. Like, it's bull. It's total BS. I'm out. I'm gonna basically never talk about money again. I will just, go and be a mortgage broker and teach ballroom dancing on the side. And that's it. And that's kind of what I started to do. But of course, it drove me nuts. These guys in their 20s and 30s that were financially independent knew things that I didn't. So eventually I started to learn from these guys. And by later in 2006, I was able to be financially independent myself. And then, in 2007, came out of retirement to teach people how to do what I did. So that's kind of the long story, short story of it.
Yeah. And you touch on this, obviously, but anybody could be a financial advisor.
Yeah.
And the folks that, what you do, you take a test to be certified or something,
Yeah. You just have to pass 70% on a test and you're good. You just have to have a heartbeat.
I don't know of a single financial advisor who's financially free. And I don't understand why you got to take a test. So I guess that the regulations that are put in place are satisfied. But right. Beyond that, like there should be, if you're going to financially advise someone, it could be stocks. It could be anything, but if you've done what you say you've done, or or at least you've done what you're teaching other people to do, at least you're credible then. So I've never really put much stock into financial advising.
No pun intended.
Yeah. But isn't it crazy? A business that's regulated by the government doesn't have stricter requirements, and it's never really made a whole lot of sense. So
that's a thing. It's regulated by the financial industry, right? I mean, and they're the lobbyists. They're the ones that got all the big money, the deep pockets that are paying the politicians, and they're lobbying for this kind of stuff. And so, and the politicians like it too, because if you take the burden of responsibility off of the government, off of trying to make it a socialistic welfare system and put it in people's hands and say, hey, I'm going to invest and save my own money. Because really, people aren't investors when they put money in mutual funds. They're savers, right? They're just saving money. They're putting it away for the long haul, hopefully that they might have something. But the truth is that, all they have to do is say, you know what, you didn't make it. Well, it's because you didn't save enough, right? Even if that person saved exactly what a financial advisor would have told them to do, there's so many things to not keep them accountable, right? Plus, most financial advisors never last that long anyway. So who's to keep you accountable regardless? That's the problem I see, is that it's, the government's like, hey, it's cool. It's giving them something to save in that's not relying on us trying to pay them Social Security, right?
So that leads me to passive income.
Mm-hmm.
So you discovered real estate. You told me off air you became financially free. I'm assuming that you said you lost it all and then you had to become financially free again.
Mm-hmm.
So I'm assuming that had something to do with 2008, 2009.
Absolutely.
Okay.
Yeah.
So I don't want to get into all that, but you've had to do it twice. You've had to kind of do this twice. Mm-hmm. And you use the phrase passive income. Tell me what you mean by that.
Yeah. I mean, it's not much different than what probably you've heard before, right? It's, do we get streams of income coming in where we're not having to actively work for it, right? Because like in the real estate investing world, a lot of times people say, well, I'm a real estate investor. Well, if you're a wholesaler or a flipper, you're not getting passive income. You're creating active income. You're transactional in your wealth, right? Even if you make millions and millions of dollars, it's transactional. Passive income means, hey, even if my business gets shut down because all of a sudden you're a non-essential business, or they just don't like wholesalers anymore, things like that, you got to have some other streams of income coming in. And that's what I mean by passive income. This could be long-term rental income. This could be money coming from syndications. It could be money coming from all sorts of sources, right? Things that are coming in passively where your money's working for you, so you don't have to keep working for your money.
But essentially, and I understand what you're saying, but essentially there's all even passive income, there's some work involved. It's not like you just set it and you forget about it and all this money's going to come rolling in. So tell me this, Chris, how would, say I'm just getting started and maybe I've dabbled in wholesaling, maybe I've dabbled in some rehabbing, maybe I've dabbled in some of this stuff. How do you suggest somebody really get going down the path of maybe how it was you, maybe it was how you were taught, maybe it was how someone else you saw, but how would you suggest people start getting down the road of passive income?
Wherever you are, start with the easiest place where you're standing, right? I mean, for example, if you're somebody, you are wholesaling, or maybe you are a rehabber, do you cherry pick some of those and keep them in your portfolio, right? Now, me personally, I hate active real estate investing, right? Like I don't like it at all. I'm much more like, I like to buy turnkey real estate properties. So I'll buy those. Like I won't go out searching for them, but you might love this hunt. You might love the search. So you might do it, but you might leverage somebody else that's already doing it. You might know other guys that are in that market and they've got properties. You might say, hey, you find a really good deal where I can get some nice cash on cash returns. Let me know. I'll snag that from you. I mean, you take some of your money and put it towards something like that. But go for that path of least resistance, right? The one that's closest to whatever you're doing. I even know deals you can do that's in like oil. You can do things with mineral rights and things like that. If you're in that space, great. We'll go down that space, but find the things that are easier. If you're doing stuff, if you know people that are doing multifamily, great. Maybe you do multifamily, whatever you're most comfortable with, start there and then start to build your portfolio beyond that.
So let's talk to that person who, I've been maybe watching, maybe listening to your podcast. By the way, we're gonna talk about that in a minute. Chris Miles, the Chris Miles Money Show. We're gonna talk about your podcast here in a second. So whether you're listening to Chris's podcast, you've been watching our videos and listening to our podcast, whatever it might be, you've been going down the pathway to reading some books, educating yourself to the best of your ability, but you're probably still working a 9-to-5 job. It's a lot of folks I talk to, a lot of folks who are listening to the show. What direction do I go in, Chris? We're not going to be able to save our way to wealth. That doesn't typically happen. That's not really, you mentioned that earlier. That's not really something that happens. What do we do? Do we start, I've heard about this wholesaling thing. Do I start a wholesaling business? Do I start creating some active income so that I can start passively investing? Can I passively invest today without a lot of, with my current job, things like that? What would you suggest to someone who's kind of dabbling in some education and wants to start getting going?
Yeah. First things is it depends on where you're starting from, right? If you're just dabbling, but you don't really have any cash, then obviously we can't take money to turn it into money for you. But you can use time and energy. So like you said, like, can we do active investing? Yeah, you could do something with more an active business. Maybe you are doing something with wholesaling or whatnot. If you go that route, here would be my warning, right? Is I would only suggest doing a new business if it ties in with some sort of passion that you have. If it's something that would be fun for you. Because the one thing I've noticed is that if someone who like currently has a job and then tries to start a business that feels like a job for them, they're only doing it for the paycheck. Well, then that's not the route we want to take, is it? Because we don't want to just do a business because it's a paycheck. Because trust me, starting a business, launching something like that is way more headache than just getting a job. Like it's a lot more work, a lot more hassle. You have to be kind of insane, certifiably insane to want to start a business, unless there's some sort of passion there. So aim for the passion, something that you'd be interested in that doesn't feel like a lot of work for you. That's if you take the active route. Now, if your job, gives you, and you've got extra cash on the side, maybe you've been dumping it in the crappy 401ks, which do not work, by the way. The match does not do anything. But say you've been putting money there, or you've been putting money into savings. Great. Can we put that money somewhere else where it works for you? And that's where you can do things. Like if you've got at least $30,000, go get your, if you have no real estate experience, get a turnkey real estate property. Focus on something like that where everything is done for you, right? Where they find the property for you. You just have to select it. They help you, get the property management in place. They help you get the financing in place. They do everything, everything that you don't have to worry about, right? You just have to worry about qualifying for a loan. And if you have a job, perfect. If you don't have a job, that's not the option. We look at other things, right? Like maybe different funds or something like that where we can put money into and it doesn't require anything. And there's even turnkey providers. I know that if you did buy all out in cash, you could still get at least 10% cash on cash return. And that's the thing too, by the way, like when I look for properties, specifically like turnkey properties, I want at least a 10 to 12% cash on cash return. And that's after property management fees and everything, so I don't go for, there are some turnkey guys out there and they're great people, but when you're seeing like 5-6% cash on cash, that's just not exciting enough. And the truth is, if you ever have a time where somebody doesn't pay rent, now you're going to be possibly have a loss for the year instead of a gain. So you got to be careful of that.
And I want to come back to turnkey investing here in a second and 401ks. You say 401ks don't work. I want to come back to both of those topics. But first, I want to ask you this. Everything you're mentioning right now is kind of like, 10%, even 12%. It gets you excited, 14%. There might be some people here watching this right now where that doesn't get them excited at all. And I need a home run. I need a big hitter. What can I do to get a big hitter, Chris? Is that possible? What do I do?
It's possible. And remember, when I'm saying like 10 or 12%, I'm talking about cash on cash return, not total return, right? Like, for example, I bought a Memphis turnkey property 3 years ago, and it's already done of almost a 300% rate of return total with appreciation, equity, from paying down the mortgage, the renter's paying down my mortgage, right? Not even including tax breaks. So remember, that's still a pretty big deal. Now, if you want something more than that, it might require more active investing. It might require more of your time and energy. Anything you can put time and energy into can increase those returns. I know I have friends that do land investing, buy raw land, they flip it, they can make triple digit returns year after year. But here's the thing, it's going to take at least to get to that level, 10 to 20 hours a week, plus some good solid education in there. Same thing with like wholesaling, same thing with flipping, right? Like it's always requires education and a lot of time and energy with it.
So let's talk about turnkey investing, because it's for some people it's been a great thing. For some people it hasn't been. You mentioned first, let's define some things real quick before we get into turkey. You mentioned cash on cash, guys. I've got videos on this. We'll link them up here just to make sure we're all on the same page. But just quickly, the difference between cash on cash return and then your total return, because you just mentioned both of those, and I want to make sure that everybody's following along.
Absolutely. So cash return is like the money you're actually getting from the cash flow, from the monthly, rent payments are coming in. So for example, say you put $30,000 down on our property. It's a $150,000 property. You put 20% down. That's $30,000. If it were to pay you a 10% cash on cash, that means you're making $3,000 a year in net cash flow after you've paid your mortgage payment, you've paid taxes, insurance, right? You've paid your property management fees, all of that. That's what you're left over with. So you had $3,000 of profit off of 30,000. That's a 10% cash on cash, right? But that's not the only money you make. Now, even if that was the only money you make, that's not a bad thing, because from the financial advising world that I came from, if you had $30,000, you're telling people to live on no more than 2 or 3% a year, right? So you have $30,000, you're like, hey, you know what? You shouldn't pull out more than 600 or 900 bucks a year. You know, you'll be rich, right? So big difference between 600 to 900 bucks a year in the financial planning world versus 3,000. But here's the cool thing too, is that there's the fact that they're paying down your mortgage for you. So say it was $30,000 down, but it's a $150,000 property. There's a $120,000 mortgage that you're having about, if you do a 30-year mortgage, about, of what the rent is being paid, not the $3,000 a year, right? Not that money. The other money we already took out. Some of that money is going to paying down your loan, right? They're paying down your mortgage balance, probably to the tune of about $1,500 to $2,000 a year and increasing each year, right? So even if you only made the 3,000, still you might have made at least, most likely at least $1,500 to $2,000 in just equity gain, even without appreciation. Now, remember, let's just use the number 1,500. This is the easy number here. That 1,500 is like adding an extra 2% a year. Sorry, more than that. Actually, that's more like a 5% a year that you're getting off of that 30,000, right? Again, you paid nothing for that. That was just from the rent that's coming in. That doesn't include anything with appreciation. If you only put 20% down on property, here's the fun thing with appreciation. You get a 5 times effect on your returns. Mm-hmm. So say that appreciation goes up 10%. So you bought that for 150,000. It goes up 10%. Now it's worth 165,000 because you made 15,000 of equity gain. Well, remember that 15,000 wasn't just on the 150,000. That's what I did understand as a financial advisor. I would tell people, properties go up like 3% a year. That's nothing compared to the stock market. They're awesome. It's like 20,000% a year, right? But the truth is that even 10% on a property, that 15,000 on your 30,000 was a 50%, not 10% gain, a 50% gain because you use bank leverage and got a lot more return. Mm-hmm. So it's very possible that in a year, it's not unlikely to see 30, 40, 50 plus total percent returns on your money. That's just, you can't find a stock that can do that. You cannot find a financial advisor who will say, hey, can you guarantee I'll get at least 30, 40, 50% a year? They can't.
Yeah. And just real quick, guys, to summarize what Chris just said, you're sitting here talking about the cash flow. There's 4 ways to make money with any investment. He talked about the cash flow. He talked about the principal pay down, which is where someone else is paying the mortgage for you. He talked about the appreciation. And then one you might have forgotten is the tax benefits. Mm-hmm. The depreciation, you get to depreciate these assets. And now all of a sudden that $3,000 on this particular example of net cash flow you're going to get back for that specific example, most of that money is going to end up being completely tax-free based on that price point, based on the depreciation of the asset. So the tax benefits is another huge key with real estate. So I agree with all of that. Awesome stuff. Love it, Chris. Here is where I have a problem with turnkey real estate. And I want you to be the advocate for it. And I'm going to play the little devil's advocate, okay? You don't always get the $3,000 cash flow, okay? It sounds great on paper. I don't know of anyone who's gotten rich off of one property. The folks I know who have really done well with holding single family real estate is in the numbers. They really got to have a lot of properties because there's tenants not paying. This COVID mess we just had, maybe they don't have to pay. Trash in the house. There are all these other things. What if the market takes a dip? Obviously, we haven't seen that in the last 10 to 12 years, but what if the market takes a dip? That appreciation you just got done talking about, wiped out. What about all the negatives? Obviously, there's a lot of positives too, but what about all these negatives to turnkey real estate as well?
Yeah, there definitely are. I mean, those are all negatives you should take into consideration when you do it, right? because crap can happen. And the truth is that can happen in anything we're doing,
Yes.
right? For that matter. Here's the difference though, is that, say it does happen to the property. Now there's things you can do up front, due diligence wise, to help minimize risk. Like, I encourage people like, hey, make sure you check the neighborhood, make sure it's a good neighborhood. Like I'll street view and Google map it just to go through and walk through around a few blocks of it just to see how it feels, right? It's not what I want to live there, but would at least a decent, average middle-class American want to live there? I like to go for a little bit higher quality type of rentals that way. The other thing too is, have things been repaired? Is this place like new? Is it rent ready? When you go to a turnkey company, you got to be very specific about this, because some turnkey companies will say, oh, well, we're going to renovate it after you buy it. Well, that's going to be a little bit more risk, right? I want to make sure it's got new HVAC, it's got new air conditioning or heating unit in it. Does it have has the roof been repaired? Make sure that the home inspection report looks good, because if there's anything wrong, let's make sure those things get fixed before I close or I'm backing out. So that will help minimize some of that risk. But again, there's no guarantees. There can always be vacancies, right? And I agree. You can't do it off one property. If you're going to buy these properties, that's, again, I said where you start. If you're just starting, that could be a great place to start. That being said, you'll want to have multiple of those properties, but that's not going to be your answer, because what's going to likely happen is probably within 3 to 7 years, depending on appreciation, we're going to get to a point where you'll see your return, what's called return on equity, right? Which is how much equity you have in the property versus the cash flow you're getting. Like I have a client who has a California duplex, and anything on the West Coast, I'm like, sell it. There's not enough, but he has $200 a month coming from it, but there's $700,000 of equity. Mm-hmm. So that means he's getting more he's not even getting 1%, it's just
his return on equity.
His return on equity. He's getting like a third of 1%, right? I said, man, let's sell this 1031 tax-free exchange into other properties, even if it's just multifamily, fourplexes or bigger, right? Or multiple type of duplexes or whatever. 1031 into those properties. And even if you only got 10%, that's still $70,000 a year versus $2,400 a year, right? And again, like you said, tax advantage. But that's the thing is, again, there's no guarantee. So you got to buffer in for that. You always got to go above whatever your cash flow goal is. If you want 10,000 a month, if you're buying a lot of turnkeys, you may want to hit 12,000 a month on those turnkeys before you say, I'm there.
So, that kind of really leads me to my next question is, as the anti-financial advisor, Chris, how many is that number? Like if I were to say, turnkey real estate, I get it. I like it. It's something I do want to do. I don't want to just buy one. I'm going to have multiple. Is there a magic number?
It depends on the person. With every person that we work with one-on-one, we try to cater that plan around what they want, because some of them don't want any properties, right? While others love having real estate properties like that. And so it depends. The truth is, we're probably going to have a mixture. We're probably not going to put it all in turnkeys. We're probably going to be doing some things where we're buying it to multifamily. Maybe do some syndications there. Maybe we do some self-storage. Maybe we're doing some things with assisted living, or maybe we're doing some things with oil, right? Or whatever it might be. Things to diversify beyond just doing those kind of investments. Again, when you're starting out, like getting those properties can be a good boost. You get some good growth on it, but that's not the end all. Now, if somebody tries to go for that, it just depends, right? It depends on what they're aiming for. If they're going for 10,000 a month, you're probably going to be buying like 2 duplexes and fourplexes to help alleviate having to buy so many properties.
Yeah. And now you're sitting here talking about economies of scale. Now you're sitting here talking about where we've got a lot more property here too. If one goes vacant, one doesn't pay, one has a high cost kind of turnover. Somebody leaves and they kind of messed it up a little bit more than you anticipated. You got a little bit bigger expenses. Now you've got, and this is where it comes in, the importance of reserves. Like when I typically, you tell me what you say to folks. If I know, if I'm consulting with someone and I know they've bought only 1 or 2 or 3 turnkey properties, or they have 1 or 2 or 3 properties, I tell them not to spend any of that cash flow. If they're making $3,000 a year in net, that all goes into an account. You don't touch it and just let it sit there and accumulate for reserves, just in case the worst were to happen. What do you
Especially
say?
In the beginning? Yeah, absolutely. Like I if somebody's just getting a simple single family home, I might say keep $5,000 or save and keep 5,000, that first 5,000 before you start pulling any money out, right? And trying to reinvest. But if you got 3, that's probably going to be at least 10,000 you want to keep on the side, right? And of course, as you go higher and higher, that the amount you save per property is less and less, because the likelihood that anything happens all at once is pretty much 0, right? But it's, yeah, you're right. You got to keep some of that cash aside and then start to build up some of those reserves later.
401ks don't work. Why don't they work, Chris? Tell me why they don't work. Even with an employer match. Well, I've always been told someone's got a job, at least put in up to the match and then don't do anything else. You say, no, don't mess with them at all.
You know, if you're not going to do anything that we're talking about on this show, then great. Have fun with your 401k. Here's the problem. 401ks have yet to ever work, right? Unless you want to live like a pauper in retirement, right? You want to live broke, great. But the truth is they just don't work. And if you're only going to do up to the match, you're not going to save enough to make a difference anyways. Here's the thing that people mistakenly think is they think, well, I'll just do up to the match. Maybe I get that 50% match, right? Or maybe I'll get even 100% match at best. Say you get that 100% match. The mistake people make is they think they get a 100% rate of return. That's false, right? Because, I mean, try this. I mean, try putting in, say you're putting in $10,000 a year, you get matched $10,000 a year, right? But just say you put in 10,000 and you put in there 107% rate of return, 100% for the match, 7% for the market returns. And watch what happens. If you're putting in 10,000 a year, watch what happens in 20 years. You're going to end up being richer than Bezos, right? You're going to be rich. You're going to be one of the richest people in the world. Do you know anybody with a 401k that's on the billionaires list? I mean, even the Fortune 500, nobody. It's not a true 100% return. It is in the beginning, but remember, that's not a compounded 100% return. It's just doubling your end number. And the longer you save in those plans, you know, if you heard like the rule of 72, which is, you know, you figure out like you divide it in 72 years, right? You divide in 72, the interest rate you're earning. Now, so if you only get a 2% rate of return on a CD, it's going to take you 36 years to double your money with compounding, right? Well, it's the reverse too. If all that money does is double for you and you've been saving that 401k plan for 40 years, you're getting about like a 1.5% total net return at best. You know, for people that save 20 or 30 years, you're really only getting maybe a 2.5% extra return by getting that full match. That's it. And remember, the stock market doesn't do 10 or 12% like I used to teach as financial advisor. That's the average return, the average, right? You know, that's like saying you lose half and then you got to get 100% to double it. So minus 50 plus 100 is 50 divided by 2 years. You make a 25% rate of return, but you get broke even. You know, that kind of stuff that they do in their math. They do these tricky, funny numbers, right? Here's the key though, is that the real rate of return of the stock market for the S&P 500 in the last 30 years to date has been about 8.4%. That's before fees come out. And most people in their mutual funds never even get those returns, right? So say you only make 7 or 8%, it's not 10 or 12. Those numbers just dwindle down lower and lower to the point where you say, man, I got to put away $50,000, $100,000 a year just to have a hope of a good retirement. It's not worth it to me. Even if you think you might get a 9% return on your money with the 401k match, it's not enough to compete with what we can do in real estate with less risk.
Well, then tell me what people, as the anti-financial advisor, you're our resident anti-financial advisor today. What should people do who are working a full-time job and they have the opportunity to put money into a 401k? What should they do?
No, don't do it.
So what do they do with that money?
Don't fall for that trap. Even if you say, well, I'm 58. Well, what's the benefit there? Because most people tell you the 401k, you get to delay your tax, right? Well, they tell you it's a tax write-off, right? Oh, I don't pay taxes on that money. Yeah, you do. You just pay them later. Do you really trust that you're going to be a lower tax bracket? And if you are in a lower tax bracket, it's because you failed. Your financial planner failed you, right? Because you didn't make any money. Therefore, you're broke. And that's why you have tax breaks. So why would you do it even at 58? It's not worth it. So don't put new money there. And if you've already done it, fine. You can actually, if you have an old 401k, for example, maybe it's not in your current employer, but you have an old 401k, you can move that into what's called a self-directed IRA. And then you can invest that in some of these things that we talk about here on the show. But don't put new money in there because it's just putting your money in prison. That's what you want to avoid. Do not put your money in prison where it gets locked up. You can't touch it. It's like asking mom and dad for the car keys, right? But you want to be able to have that money away from being locked up. You don't want to wait till you're 60. What if you could do it? What if you could retire in your 40s or even earlier?
Well, Chris, here's the reality though.
Mhm.
And I'm not arguing with you at all. Like
Uh-huh.
everything you're saying is dead on. But here's the reality. People are not, they're not disciplined
Mhm.
enough to take that money that they're not putting in the 401k and now they're getting it. They're not disciplined enough to save that to invest. And that's
That's what they lead you to believe. I mean, that's what the Dave Ramsey of the world teach us, right? Is that everybody's a spender. Only the few, the proud, the elite are savers, right? But look at the numbers. If you actually
let's look
look,
at
I
the
actually
numbers.
researched this the last couple of months,
Okay.
right? I was like, well, what do a 401k do? Like how many people are actually investing in their 401ks? Did you know that more than about 54% of people are actually investing in their 401ks right now that are eligible? That doesn't include people like ourselves that are eligible for a 401k, but we don't do it because we know there's better things, right? There's still a percentage of us there. What that implies is then that majority of people are saving money in their 401ks. Majority of people are savers. The minority are spenders. And so we've been taught by media that, oh, you got to do this plan. Well, they're making it sound like nobody is saving. But the truth is, the majority of Americans are saving money. Now, there are some undisciplined people, and that's a whole nother issue, right? Like that's usually more of a mental or emotional issue than it is more of a discipline issue. And sometimes it's an issue because some people will say, I'm not saving my 401k because it just doesn't feel right. I don't know why, but I'm not doing it. I'm not sure why, but I'm just letting it sit in savings, right? I'm not even putting the 401k, but it's just sitting there in savings. I had a guy I talked to in California as an attorney, saved 900 grand in savings because he didn't trust the stock market, but he didn't know what to do with it either. He just lets it sit there, really losing to inflation.
Mm-hmm.
I was like, well, if we can even get a 10% return on that, that's 90,000 a year. All
Mm-hmm.
he needs, by the way, is about 120,000 a year. He's out of the rat race. Like within the next couple of years, he could actually be, by the time he's about 40, financially independent.
And with leverage, how much real estate could he buy with that? How much could he?
Oh,
Because real
tons.
estate's really the main thing that you can leverage,
Yeah. He
and
could buy
really,
at least a few $1 million of real estate easily, right? If he wanted to do that.
yeah.
And he probably won't buy all the real estate, but he might go and invest in other types of real estate where he doesn't even have to get leverage, right? He can just go and throw money at people and let them handle it all.
So that's I want to get you out of here on this. This is kind of like the last big question I want to ask you. We talked about turnkey real estate. We've
Mhm.
talked about some other investments, not investing in a 401k. What are some other things that you've mentioned some kind of like, we didn't really deep dive them though. You mentioned
Mhm.
potentially like mineral rights and syndication. What are some investments right now, some places we should be putting our money that maybe we just don't know a whole lot about, and maybe expound upon those a little bit?
Yeah, I mean, we don't want to ever give investment advice blanket, right? I mean, that's illegal for us to do.
Well, but
Um,
what are you really seeing right now that's really working for you and some of your clients?
I mean, lots of places. I mean, beyond just the turnkey stuff, like even in the syndication side, I mean, multifamily apartments, right? I'm seeing lots of stuff work there. Commercial, like business real estate, I mean, that's a little iffy. You have to be in the right deals, but there's still good pockets there. For example, self storage. Self storage is buying a lot of these old Kmart type buildings, converting them to self storage and making massive profits, right? Even though it's too expensive to build ground up construction, they can still go and convert these to self storage. I've seen, like even like outside of real estate. Well, actually, even in real estate, raw land. I've seen people like make good money there, even partnering on people with deals that are doing raw land, saying, "Hey, I'll finance it. You do a lot of the work, and let's split the proceeds." Right? You can do a private partnership with people. Lending, short-term lending is amazing right now when people are doing that, kind of like renovated, type of strategy where they're renovating stuff. So I have a lot of people doing stuff with short-term lending, earning double digits on that. Franchises. You want to go outside of real estate. Franchises is another place you can look at where there could be some time and energy involved, but you can, if you have enough cash, if you have at least a few $100,000, there's options where you might spend the first few months working part-time in that business and then back off to 5, 10 hours a week, managing it, making six figures. There's ways to do that. There's other things like I mentioned. Yeah, you mentioned like oil and gas, right? Like those kind of things. I've seen some deals where they're paying double digits even in the first year, which that's pretty rare for an oil deal. But if you find the right ones, you can actually still make double digits in the first year, and that can pay ongoing cash flow with a little bit of a tax reduction because oil actually gives you a little bit of a benefit there.
I didn't hear you say crypto.
No, no, I didn't say crypto. Hey, I'm not saying you don't have any crypto, right? But I put crypto in the same category as stocks. It's very speculative. It's great, but don't bank your whole life on it. Like you shouldn't bank your financial freedom on it because you're going to end up like everybody else that's just speculating. It's a speculative thing. So if you're going to use something like that, don't put much more than like 5% of your total money into something in that way. Like I've got some, but it's very tiny that if I lost it all, it would do nothing to my financial situation.
And real quick, I do want to ask you, how do people get involved in something like a syndication, something like even a multifamily project or a self-storage project, private lending? How do we find the people that are operating and doing those things so we can just passively invest in those types of things? How do we find these people?
Well, they're everywhere. I mean, if you know where to look, you'll just see there's more than enough out there. Not saying they're all good, right? But especially lately, in the last few years, a lot of people have popped up that maybe are just inexperienced, but they're out there. The best thing to do is get associated with people like you and I, right? Like people that we know, people in that space that are proven, like they've done it for years. They do it like the back of their hand. Like they can almost be asleep and do that same deal they've done over and over again. They've repeated over the years. That's the kind of turnkey provider, or not turnkey provider, syndicator you want to find, right? Like I know one guy that I've referred my clients to. He's paid every investor since 2003 through a couple of the last recessions. He never stopped paying his investors. That's the kind of integrity that you just can't buy with money, right? Like that's the kind of stuff you want to look for.
Yeah. That's good stuff, man. Tell everybody about the podcast. How do they find it? What's it called? What do you talk about? Is it interview style? What do you do on the podcast? The Chris Miles Money Show.
Yeah. The Chris Miles Money Show, you can find anywhere. iTunes, YouTube, Audible. Apparently I just found that out recently. I didn't even know it was on Audible, but it's been there the whole time. Pretty much anywhere you listen to podcasts, you can find the Chris Miles Money Show, right? The whole point of the show is really for that person that's looking to create passive income. You know, like what is that I do? Like, how do I get started? Right. You know, all that kind of stuff. We hit different topics. It's twice a week show. One's with just me and then the other's with a guest. And so I bring on guests as well, bring up different topics. We just had somebody talk about 1031s and how to exchange from a property into a multifamily, you know, syndication, or even into land. Like in fact, I just talked to our oil provider and they said, yeah, we can take real estate money and move into oil. So if they don't even want to deal with real estate, we can move it into that instead, you know, like that kind of stuff. We just bring up a variety of topics, all in the really the whole end goal is how we get you financially independent by 2030 in the next 9 years. Like, how do we really get you there where you work because you want to, not because you have to, where you can do all the things you want to do. You have all the cash flow, freedom, prosperity to be with whoever you want and do whatever the heck you want. Right.
Guys, go to the description, go to the show notes right now and check out the link. I'll put all the links there for the Chris Miles Money Show. Go check out Chris, give him some love. Chris, we can't thank you enough for your time, man. I appreciate you.
Hey, it's such a pleasure. I appreciate being on, Brian.
Guys, hit subscribe to our channel, hit that like button as well. Ring the bell for the notifications. We love you so much. We're going to see you next time.